If you are over 70 and a half and you give money to a church or a charity, the IRS has a loophole that allows you to send that money directly from your IRA, satisfying your required minimum distribution without a single dollar ever touching your taxable income. Most retirees are missing this, wiring money into their bank account, getting hit with taxes, and then writing a check, which is like volunteering to overpay the government by thousands of dollars every single year. And once you understand the single rule that makes this work, you will never process a donation the old way again. It's called a qualified charitable distribution, a tax rule hiding in plain sight for nearly 2 decades. Yet every year, retirees pay unnecessary taxes on donations they could make directly from their IRA, simply because they don't know the rule. So, why is this the best-kept secret in retirement planning? Here is what most people do with their required minimum distribution every year. The money leaves the IRA, lands in a bank account, and instantly becomes taxable income. Then they write a check to their church or their favorite cause, and they might get a deduction if they itemize. But here's the problem. Since 2018, the standard deduction nearly doubled, which means fewer than 10% of taxpayers now itemize. So for 90% of retirees, that donation provides zero tax benefit. They are paying income tax on money they are giving away. Now look at what the smart money does instead. The distribution never touches a bank account. The check goes straight from the IRA custodian to the charity. And because of a provision buried in the tax code since 2006, the IRS treats that transfer as if it never happened. It counts toward your RMD, but it does not count as income. Not deferred, not deducted, excluded entirely, and when you exclude income rather than deduct it, everything else in your return gets cheaper. This matters because your adjusted gross income is the number that determines what you pay for Medicare premiums, how much of your Social Security gets taxed, and whether you qualify for dozens of credits and deductions. Lower that number by $10,000 through a qualified charitable distribution, and you might save an extra $2,000 or $3,000 on healthcare costs alone, money that has nothing to do with the donation itself. The law that created this was signed by President George W. Bush as part of the Pension Protection Act, and it was originally temporary, renewed year after year, until Congress made it permanent in 2015. They understood something most retirees still have not figured out. When you give from an IRA, you are giving pre-tax dollars, the most powerful charitable currency in the American tax system. You funded that account with money the government never taxed. It grew without taxes for decades, and now you can direct it to a charity without anyone taking a cut. Not the IRS, not your state, not your accountant's surprise bill in April. But here is what nobody tells you. There is exactly one way to get this wrong, and the mistake is so common that financial advisors have a name for it. They call it the phantom RMD trap. And if you fall into it, the IRS will tax the money and disallow the entire benefit, leaving you with a bill you could have avoided with a single phone call. Here is exactly how the phantom RMD trap works. You turn 73. The IRS requires you to withdraw $12,000 from your IRA by December 31st. You call your custodian. They transfer the full $12,000 into your checking account. That money is now taxable income. A week later, you write a $5,000 check to your church. You feel generous, you feel responsible, and you assume the deduction will offset the tax. It will not. Not if you take the standard deduction, which over 90% of retirees now do. That $5,000 of income remains taxable, and your donation bought you exactly zero tax savings. You just paid income tax on money you gave away, and there is no do-over button. Once the distribution hits your personal account, the qualified charitable distribution election is dead. The IRS will not reclassify it after the fact, no matter how many letters your accountant writes. Now, rewind the tape and do it the right way. Before you take a single dollar of your RMD, you instruct your IRA custodian to issue a check directly to the charity for $5,000. The check must be made payable to the organization, not to you. It can be mailed to your home address so you can deliver it personally. But the payee line must never show your name. That $5,000 satisfies part of your RMD, leaves your IRA, and vanishes from your tax return as if it never existed. Then you withdraw the remaining $7,000, which is all the IRS ever taxes you on. Same amount to charity, same amount in your pocket, thousands of dollars less in tax. But the trap has a second layer that catches even people who know the direct transfer rule. Timing. The IRS mandates that QCDs count only if they are distributed before your RMD is fully satisfied. If you take your entire RMD in February and decide in November to make a QCD, you are out of luck. The order is ironclad. QCDs first, then the remainder. Get this wrong, and you cannot unwind it. The custodian cannot recharacterize the earlier distribution. The IRS will treat the full amount as taxable and your later charitable check as a separate private donation, which, again, is useless if you do not itemize. Now let us talk about what kind of charity gets this treatment. It must be a qualified 501c3 public charity. Your church qualifies. Your local food bank qualifies. Your alma mater qualifies. What does not qualify? Donor-advised funds, private foundations, and supporting organizations. If you write the check to your own donor-advised fund, congratulations, you just made a taxable distribution disguised as a QCD. The IRS will find it, and it will bill you. Also, you cannot receive anything in return. No gala tickets, no auction items, no plaque on a building. If the charity sends you a tote bag, technically the entire QCD could be disallowed, though in practice, small token gifts are often overlooked. But the law says zero benefit to the donor. Zero. Now, here is where this goes from a clever tax trick to a retirement income weapon. Your adjusted gross income. That number at the bottom of the front page of your 1040 determines your Medicare premiums. It is called Income-Related Monthly Adjustment Amount, or IRMA. If your modified adjusted gross income crosses certain thresholds, your Part B and Part D premiums jump by hundreds or even thousands of dollars per year. For a married couple filing jointly in 2025, the first surcharge kicks in at $212,000. The next bracket is $266,000. If your income sits at $214,000, a QCD of just $3,000 drops you below the line, saving you not only the income tax on that $3,000, but also roughly $1,000 in lower Medicare premiums for the entire following year. The charity got the money, the government got nothing, and your healthcare costs just dropped. That is not even counting the effect on your Social Security taxation. Up to 85% of your benefits can be taxable based on your combined income. Reduce your AGI with QCDs, and you might pull a portion of your Social Security out of the taxable zone. 2, 3, 4 different tax costs all shrink from a single properly executed transfer. The mistake most advisors make is treating the QCD as a charitable giving tool. It is not. It is an income shield. The giving is just the mechanism. And in 2023, Congress quietly passed a provision that transforms this shield into something even more powerful. Under the Secure 2.0 Act, starting in 2024, you can now direct a one-time QCD of up to $53,000 into a split interest entity, a charitable gift annuity, or a charitable remainder trust that pays you income for life, with the remainder going to charity. That is a lifetime income stream, funded entirely with pre-tax IRA dollars, satisfying your RMD, and generating a partial charitable deduction, all without the money ever appearing in your taxable income. Most CPAs do not even know this option exists yet, which means the window to use it before the rules get tightened is wide open right now. But with new powers come new fine print. And the fine print on split interest QCDs is a minefield. That $53,000 one-time transfer into a charitable gift annuity must be made directly from the IRA, just like any QCD. But it also has to meet the annuity's actuarial requirements. If the charity miscalculates your life expectancy or the payout rate, the entire transfer could be disqualified. And suddenly, you have a fully taxable distribution of $53,000 dumped into your highest income year. The IRS will not give you a mulligan because your charity's development office made a math error. Now let us zoom out to the annual QCD limit, because this is the number that changes everything for people who give generously. In 2026, the limit rises to $111,000 per individual, indexed for inflation going forward. That means a married couple filing jointly can shield up to $222,000 of IRA distributions in a single year, entirely excluded from taxable income. Think about what that does to a retiree with a large IRA and a generous heart. They satisfy their RMD, they fund their giving, and they keep their adjusted gross income artificially low, which might save them tens of thousands of dollars in Medicare premiums, prescription drug costs, and state income taxes, all in a single calendar year. But here is a disaster that plays out every December. A woman in Scottsdale, 74 years old, calls her IRA custodian on December 26th and requests a QCD check payable to her church for $15,000. The custodian prints the check and mails it. The post office is overwhelmed with holiday packages. The check arrives at the church on January 4th. Too late. The IRS rule is absolute. The check must clear the IRA by December 31st. The date of the check does not matter. The date you mailed it does not matter. What matters is the date the funds leave the account. If the custodian processes the transaction on January 3rd, that QCD counts for the next tax year, not the one you needed. And because you had already taken your full RMD for the old year, you now have a taxable distribution you cannot undo, no QCD to offset it, and a donation that simply becomes a private gift with no tax benefit. Now multiply that mistake. Imagine a financial advisor managing 30 retired clients, all requesting QCDs in the last week of the year. They think they are doing their clients a favor by maximizing the delay, keeping the money invested as long as possible. Instead, they walk straight into a processing bottleneck. Custodians are flooded with year-end requests. Some checks never get mailed until January. Clients get their 1099-R forms in February, see the full distribution amount, and panic. By then, it is too late to fix anything. This is not a theoretical. It happens every single year to thousands of people who simply did not respect the December 31st deadline. Now, let me ask you a question that reveals how deep this rabbit hole goes. What happens if you have both a traditional IRA and an inherited IRA? Do QCDs from an inherited IRA count toward your RMD from your own IRA? No, they are separate. But you can make QCDs from an inherited IRA if you are over 70 and a half, which means an adult child who inherited their parents' IRA and is already past that age can use the parents' money to fund their own charitable giving, dodging the tax on distributions they never wanted. Hardly anyone knows this. It is not in the brochures. And there is one more layer, the reporting requirement that just changed. Starting in tax year 2025, IRA custodians are supposed to report QCDs with a specific code on Form 1099-R, Code Y. In practice, many custodians do not, or use a generic code, or leave it blank. When your tax preparer enters that form into the software, if Code Y is missing, the entire distribution shows up as taxable income. The IRS matching system spits out a notice. You then have to prove to the IRS that the distribution was a QCD, with letters from the charity and the custodian, a process that months. So the trap is not just in the execution, it is in the paperwork. Get the execution right, get the paperwork wrong, and you spend the spring fighting with a computer. That is the hidden war behind every QCD. The IRS computers are not designed to trust you. They see money leaving a retirement account, and their default assumption is tax it. The only thing that stops them is the correct sequence. QCD-first, the right payee, the right charity, the date before December 31st, and the right code on the tax form. Miss one piece, and the charity gets your money, but the IRS gets its cut too. And that is where most people leave thousands of dollars on the table. Not because they did not give, but because they gave in the wrong order with the wrong paperwork. So, what is the exact sequence that guarantees you never trigger that IRS letter? That is what you need to write down right now. Write this down. Step 1. Before you withdraw a single dollar of your RMD for the year, call your IRA custodian and instruct them to issue a check directly to your qualified charity. Step 2. Confirm the payee line reads the charity's name, not yours. Step 3. Specify that the check must clear your account by December 15th at the latest, not the 31st, because you need a buffer against processing delays, holidays, and mail slowdowns. Step 4. After the QCD check has cleared, then and only then, instruct the custodian to distribute the remainder of your RMD into your personal account. That sequence, QCD first, remainder second, is the single most important rule in this entire video. Get it backwards, and the whole strategy collapses. Now for the documentation layer, because the tax return is where the ghost of every mistake comes back to haunt you. When you receive your Form 1099-R in January, the total distribution amount will be listed in Box 1. There is no special box that says QCD. The full amount leaving your IRA will appear as an ordinary distribution. Your job on your tax return is to report the full amount on Form 1040, line 4A, then enter the taxable amount on line 4B, and you write QCD next to that line. If you use software, most programs have a checkbox or a field where you manually indicate that part of the distribution was a qualified charitable distribution. If you skip that field, the software assumes everything is taxable and you get the letter. Your tax preparer must also know that some custodians do not report Code Y on the 1099-R, even though they are supposed to starting this year. If the code is missing, the IRS computer will flag the return, but your documentation, a copy of the check from the custodian and a letter from the charity acknowledging the gift, will settle any audit. Keep both documents for at least 3 years. Now, here is the surprising detail nobody mentions. The QCD does not just shrink your income tax and your Medicare premiums. It also reduces your modified adjusted gross income for purposes of the 3.8% net investment income tax. If you have rental properties, dividends, or capital gains, a large QCD can pull your magi below the $250,000 threshold for married couples and eliminate that surtax entirely. That is a tax on top of a tax being erased by a charitable transfer that costs you nothing. The charity received money you would have been forced to withdraw anyway. You lost no purchasing power. You simply rerouted a mandatory distribution away from the IRS and toward a cause you already cared about. Most people spend decades building their retirement accounts, then hand a portion straight to the tax man because they never learned the exit strategy. You just did. The QCD is not a loophole for the wealthy. It is a congressionally endorsed transfer of wealth from your IRA to the causes you love, tax-free, and the only cost is knowing the sequence. Every November, run the checklist. QCD first, remainder second. Check mailed by December 15th, confirm the payee line, keep the letter. Do that, and you will never pay $1 of unnecessary tax on your giving again. Now, here is something that matters even more. People who control their money control their lives. People who do not become servants to a system designed to confuse them. You just learned a rule that fewer than 5% of retirees use correctly. That alone puts you ahead. But you need to keep learning, because the tax code shifts, new provisions appear, and the people who win are the ones who stay ahead of the changes. If this made sense to you, hit the like button and subscribe. It tells me you want more content like this. And because you stuck around to the end, I have a special offer for you. Go to the first pinned comment in the description below. Click that link, and you will get access to something I built specifically for people who want to take this further. I will see you in the next one.